Welcome back to Beyond the Benchmark. I'm Ryan Kasper. As we wrap up the final full week of the year, the latest batch of economic data gave us a clearer, though still slightly delayed, picture of where the economy stands heading into 2026. The headline number last week was third quarter GDP, which came in stronger than expected at 4.3%. That growth was driven largely by resilient consumer spending, particularly in services and non-durable goods, along with contributions from government spending and net exports. At the same time, investment was more mixed, with strength in equipment and intellectual property tied to technology and AI spending, offset by continued softness in residential and commercial structures. Looking ahead, early estimates for fourth quarter growth have come down closer to a more sustainable pace, suggesting the economy is cooling but not stalling. Elsewhere, the data was more uneven. Durable goods orders declined in October, largely due to volatile aircraft orders, but underlying capital goods held up reasonably well, pointing to continued business investment beneath the surface. Industrial production was essentially flat across October and November, with gains in utilities and mining offset by weakness in manufacturing and autos. Over the past year, production has grown just enough to keep pace with inflation, reinforcing the idea of slower but still positive momentum. Consumer confidence slipped again in December, marking several consecutive monthly declines, as households grew more cautious about job prospects and income growth. Inflation expectations remain elevated in surveys, even as actual inflation has continued to trend lower. That disconnect is important. Consumers still feel the impact of higher prices, but it hasn't yet translated into a meaningful pullback in spending. Labor market data continued to soften gradually. Payroll growth remains modest, unemployment has edged higher, wage growth has cooled, and underemployment has increased, all of which supports the view that labor conditions are easing rather than breaking. From a policy standpoint, that backdrop keeps the Federal Reserve focused squarely on balancing slower growth with inflation that is no longer accelerating. Markets reflected that tempered optimism. U.S. equities posted modest gains during a lighter holiday trading week, with large-cap stocks leading and all sectors finishing higher. International stocks outperformed again, helped by a weaker dollar and central bank actions overseas. Bonds also moved higher as yields drifted lower across the curve, improving return prospects for balanced portfolios. Commodities were mixed, with strength in metals offsetting continued weakness in energy prices. So the takeaway as we head into the new year is this: growth is slowing from an unsustainably strong pace, inflation continues to cool, and financial markets are adjusting to a more normalized environment. It's a backdrop that favors diversification, patience, and discipline, especially as we transition into 2026. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. We appreciate your partnership, wish you and your families a happy and healthy new year, and we'll see you next week.